Are you stuck with tax debt from a marriage that's over? Here's what most people don't realize. The IRS has 3 legal defenses specifically designed to protect you from paying your ex-spouse's tax mistakes. In this video, I'll show you what those defenses are and how to use them, even if your divorce was finalized years ago. Hi, I'm Pietro Canestrelli. I used to work as an IRS attorney in Washington, D.C. I've seen firsthand how the IRS operates. If you're dealing with tax issues and need guidance from someone who understands the system, give me a call at 951-319-7674 for a free consultation. The first defense is innocent spouse relief. The IRS treats joint tax returns like co-signing a loan. When you sign that return, you're agreeing to be responsible for everything on it. But what if someone forged your signature on a loan application or lied about how much they were borrowing? You shouldn't be held responsible for debt created through fraud or deception. That's exactly what innocent spouse relief does. It protects you when your spouse or ex-spouse understated taxes on a joint return without your knowledge. Here's how it works. To qualify for innocent spouse relief, you need to prove that there was an understatement of tax on your joint return due to your spouse's erroneous items like unreported income, false deductions, or improper tax credits. The key word here is understatement. That means the tax return showed less tax owed than was actually due. And critically, you need to prove you did know and had no reason to know about these errors when you signed that return. Now, a lot of people hear that and think, but I signed the return, so doesn't that mean I knew? Not necessarily. The IRS understands that one spouse can control the finances, hide income, or manipulate the tax return without the other spouse knowing. If your spouse ran a business and didn't report cash income, or if they claimed deductions for expenses that never existed, and you have no involvement in these financial decisions, you can qualify. Here's what you need to do. You file Form 8857, Request for Innocent Spouse Relief. But timing matters. You generally need to file this within 2 years of the date the IRS first tries to collect the tax from you. Miss that deadline and you lose this option. The IRS will evaluate your case based on several factors, like whether you benefited from unpaid taxes, whether you knew or should have known about the errors, and whether it would be unfair to hold you responsible. One critical point: even if you knew your spouse was under-reporting income, you can still qualify if you were under duress. If your spouse threatened you, controlled all the finances, or put you in a situation where you feared for your safety, the IRS takes that into account. But you need documentations like police reports, restraining orders, witness statements to prove it. Now, what if you knew about the errors, but you can't prove that you were completely innocent? That brings us to option 2, separation of liability relief. Separation of liability relief is designed for people who are divorced, legally separated, or who lived apart from their spouse for at least 12 months. And here's how it works. The IRS looks at the joint tax return and separates the tax liability based on which spouse's income or deductions caused the understatement. You're only held responsible for the portion of the tax debt. For your portion of the tax debt, not your ex-spouse's. Let's say your joint return showed $100,000 in income. $30,000 was your income from your job, and $70,000 was your ex-spouse's income from a business they ran. The ex-spouse failed to report an additional $50,000 in business income and claimed fraudulent tax deductions. Under separation of liability relief, the IRS calculates how much of the tax debt is attributable to your ex-spouse's errors, and you're only liable for the portion related to your own income. Now, here's the part that frustrates a lot of people. Your divorce decree might say your ex-spouse is responsible for the tax debt. Maybe the judge ordered them to pay it, but the IRS doesn't care about divorce decrees. Your divorce agreement is between you and your ex-spouse. It's not binding on the IRS. The IRS can still come after you for the full amount. But separation of liability relief forces the IRS to follow the same logic as the divorce decree, separating the liability based on who actually earned the income or took the improper deductions. You file Form 8857, but you're checking a different box for separation of liability instead of innocent spouse. The IRS will review the return and allocate items between you and your ex-spouse. They'll look at who earned what income, who claimed which deductions, and who had knowledge of the errors. If the IRS can't clearly allocate certain items, they'll split them equally. But the key here is that you're not stuck with the entire debt just because you signed the return. One important limitation: you need to be legally separated, divorced, or living apart. If you're still married and living together, you don't qualify for this option. And the IRS will verify your separation status, so don't try to claim that you're living apart if you weren't. They'll check tax records, mortgage records, and utility bills to confirm. Now, if neither innocent spouse nor separation of liability relief fits your situation, there's a third catch-all defense called equitable relief. Equitable relief is for cases where the first two options don't apply, but it would still be unfair for the IRS to hold you responsible. This is broader and more flexible than the other two options, but it's also harder to qualify because the IRS has much more discretion. Here's when equitable relief works. Let's say you filed a joint return and all the incomes were reported correctly, so there's no understatement, but your spouse never paid the taxes when they were due, and now the IRS is coming after you for the unpaid balance. You didn't know your spouse wasn't paying the taxes because they handled all the finances. You're now divorced, struggling financially, and forcing you to pay would create severe economic hardship. That's a situation where equitable relief might apply. The IRS looks at several factors when evaluating equitable relief. They consider whether you knew or had reasons to know that the taxes wouldn't be paid. They look at whether you benefited from the unpaid taxes. If your spouse spent the money on their own business, their own debts, or an affair, and you receive no benefit, that works in your favor. They also consider whether you would face economic hardship if forced to pay. Meaning, do you have the income and assets to pay the debt, or would it leave you unable to meet basic living expenses? Another factor is whether you were abused or controlled by your spouse. If your spouse dominated the household finances, threatened you, or isolated you from financial decisions, the IRS takes that into account. But again, you need evidence. Bank statements showing your spouse controlled all accounts, testimony from witnesses or records of domestic violence all strengthen your case. Here's what a lot of people don't understand. Equitable relief can apply even years after the tax return was filed. Unlike innocent spouse relief, which has a 2-year deadline from when the IRS starts collections, equitable relief doesn't have the same strict time limit. But you still need to file Form 8857, and the longer you wait, the harder it is to gather evidence and prove your case. One more thing about all three types of these relief options: the IRS doesn't automatically grant them. You need to make a legal argument, and you need to provide documentation. You need to understand what the IRS is looking for in these cases. Having worked at the IRS, I know exactly what factors the reviewers consider, what evidence strengthens your case, and what mistakes cause denials. A lot of people file Form 8857 on their own, get denied, and they think they're out of options. But often the denial happens because they didn't present their case correctly or didn't include the right documentation. So here's the bottom line. If you're stuck with tax debt from a marriage that's over, you don't have to accept it. Innocent spouse relief, separation of liability relief, and equitable relief are all legal defenses built into the tax code specifically to protect you. But each one has different requirements, different deadlines, and different standards of proof. Filing incorrectly or filing the wrong type of relief can result in a denial that's difficult to overturn. If you're dealing with tax debt from a marriage that's over, or the IRS is coming after you for taxes your ex-spouse created, Call me at 951-319-7674 for a free consultation. As a former IRS attorney, I know exactly how to qualify you for relief and what documentation the IRS needs to prove these cases. The sooner we start, better your chances of eliminating that tax debt.